Today, June 25th, 2025. Let's walk through the last 24 hours in the global financial markets. Over the past 2 days, global financial markets shifted decisively toward risk-taking, driven by a reduction in tensions between Israel and Iran. This de-escalation led to a sharp drop in crude oil prices, easing inflation concerns and boosting investor confidence. As a result, major U.S. equity indices hit new record highs, and international equities continued to outperform, suggesting a possible structural reallocation of global capital. U.S. equities rallied, with the S&P 500 up 1.1% and the Nasdaq up 1.4%, led by technology stocks like Nvidia, Broadcom, and AMD. The Dow also posted strong gains. The rally was largely due to the unwinding of a geopolitical risk premium, releasing pent-up demand for risk assets. International equities outperformed U.S. stocks year to date, with strong gains in Central and Eastern Europe, Africa, and Latin America. Surveys show global fund managers expect international equities to be the best performing asset class over the next 5 years, indicating a potential structural shift away from U.S. market dominance. India's main index reached its highest level since last October, and Chinese stocks hit a 6-month high, both benefiting from geopolitical calm and lower oil prices. U.S. Treasury yields were stable after Fed Chair Powell's testimony, with the 10-year and 2-year yields slightly higher and the 30-year unchanged. Treasury auctions saw strong demand from foreign central banks and institutions, reinforcing Treasury's status as a safe haven asset. Corporate bond spreads tightened, with high demand for investment-grade and longer-dated credits. Municipal bonds saw a steeper yield curve, with short-term yields falling and long-term yields rising, reflecting inflation expectations and fiscal concerns. This environment requires careful bond duration management due to potential long-term volatility. The U.S. dollar index weakened, falling below its 20-day moving average, pressured by reduced safe haven demand and diverging central bank policies. The euro hit a year-to-date high, the yen recovered, and the pound gained on risk sentiment. The Australian dollar dipped on soft inflation, while the Canadian dollar held steady. The Indian rupee depreciated against the dollar, partly due to oil price movements. Crude oil prices dropped sharply as Middle East tensions eased, removing the geopolitical risk premium. The market's focus is shifting back to supply-demand fundamentals, with rising supply likely to keep prices lower, which could have a disinflationary effect globally. Industrial metals were mixed. Platinum rose, gold traded in a range, and copper gained due to tight supply and pre-tariff shipments. Trade policy uncertainty is causing distortions in commodity markets, leading to short-term volatility and mispricing. Chair Powell reiterated a cautious, data-dependent approach, maintaining rates and reducing asset holdings at a slower pace. He noted that tariffs could push inflation higher, but the pass-through is uncertain. The European Central Bank cut rates by 25 basis points, citing progress on inflation, but remaining data-dependent due to ongoing uncertainties, including tariffs and energy prices. Bank of England held rates steady, with some members favoring cuts. The committee expects rate cuts later this year, monitoring pay growth and inflation expectations. Bank of Japan signaled likely future rate hikes as inflation approaches target, with the economy recovering moderately and inflation expectations rising. Bank of Canada held rates steady, awaiting more data on the impact of tariffs. Inflation is steady, but a modest recession is forecast due to trade uncertainty. At the Reserve Bank of Australia, inflation cooled, reinforcing expectations for a rate cut. The central bank is also focused on payment system resilience and regulatory improvements. The Swiss National Bank cut rates to 0 due to falling inflation, expecting subdued growth ahead, but anticipating a boost to real estate. Money market funds saw record inflows, reflecting a preference for short-term, low-risk assets despite the equity rally. This suggests some investors remain cautious, awaiting clearer economic signals. The broad money supply in the U.S. and globally increased partly due to a weaker dollar, which can inflate dollar-denominated values and boost U.S. asset prices. On corporate and sector developments, FedEx reported improved margins and cost reductions, but gave cautious forward guidance, leading to a drop in shares. Superior Industries International was delisted from the NYSE, moving to the pink open market, reducing liquidity and visibility for shareholders. Micron Technology, anticipated to report strong sales growth with options pricing in significant volatility. BlackBerry shares rose on strong results and a positive outlook. Tesla faced negative news on declining EU sales. Novartis completed its acquisition of Regulus Therapeutics, with ongoing global deal activity across sectors. Politically, the U.S. brokered ceasefire between Israel and Iran was the main catalyst for the market rally and oil price drop. President Trump's role in the ceasefire and ongoing U.S. diplomatic efforts were highlighted. Trade policy remains a major uncertainty. The U.S. International Trade Court ruled against Trump's use of emergency powers for tariffs, but the trade war is expected to continue, keeping tariffs a top concern for consumers and a structural headwind for markets. Other political events included U.S. participation in NATO and the Organization of American States, focusing on security and human rights. The current environment favors continued risk-taking, especially in global and U.S. technology equities. International equities are outperforming, and global fund managers are increasing exposure outside the U.S. In fixed income, short-duration U.S. Treasuries offer safety, while selective investment-grade corporates remain attractive. Currency markets present opportunities, particularly in the euro and yen, due to central bank policy divergence. Commodity markets will refocus on fundamentals, with oil likely stabilizing at lower levels unless new supply shocks occur. Options markets show reduced demand for downside protection, but such strategies are best left to sophisticated investors. Despite the current risk on sentiment, structural concerns remain. The bond market's yield curve steepening signals longer-term inflation and fiscal risks. Trade policy uncertainty, especially around tariffs, could quickly reintroduce volatility, particularly in currency and commodity markets. Robust inflows into money market funds indicate that a significant portion of capital remains cautious, waiting for clearer signals or better opportunities. The past 2 days have demonstrated the profound impact of geopolitical events on global markets. The Israel-Iran ceasefire triggered a rally in equities and a drop in oil prices, while central bank policy divergence is shaping currency and capital flows. Investors should focus on international equities, U.S. technology, short-duration treasuries, and currency trades aligned with central bank trends, while remaining vigilant for renewed geopolitical or trade-related shocks.